Now commercial banking. So I think this sentence you should have in your notes, that write it this way, that business of a bank, and then make a small flow chart. So say banks, and then break it down into two parts: commercial and investment banking. Commercial banking and investment banking. Are we okay? Okay, so commercial banking involves, among other things, deposit taking and lending activities. Investment banking is concerned with helping companies raise debt as well as equity, providing advice on mergers, acquisitions, restructuring and other corporate finance decisions. Large banks are also involved in securities trading. Okay, so they also provide services like a broker. So by providing brokerage services, commercial banking can be classified again as retail and wholesale. So in our flowchart, when we said banking, commercial and investment banking, we can again break it down into two parts: retail and wholesale. Okay, so how retail and wholesale is being distinguished with each other? So typically wholesale means large corporates, and retail means individual one-on-one borrowers. So in fact, this is one of the important criteria for determining the balance sheet of a bank. Okay, if any one of you is invested in the banking sector, if you've analyzed banks, there are certain banks whose major asset portfolio is focused on retail. Okay, so the characteristics of retail are that because your dependency on one individual client is not very high, you're not concerned about NPAs so much. I mean, the concern is always there, but in retail the threat is less. But those banks which have heavy amount of corporate loans, for them even one of the client defaulting will have significant impact on the balance sheet. Are you following this? But on the other side, with corporate, the administrative cost is relatively less. The cost of acquiring business is less because one single client will borrow large amount of money. With retail, the cost of acquiring business increases. So both of them have those pros and cons. Retail banking involves taking small deposits from private individuals or small businesses and making relatively small loans. Wholesale banking involves provision of banking to medium and large corporate clients, fund managers and other financial institutions. Do you want to ask any questions here? Sorry? Other financial what? So they can give loan to, let's say, a trading company, or they can give loan to a private equity fund, okay, on an LBO transaction, or they can give loan to anyone who's invested, who's in the financial institution business. Should we go ahead now? So the question he asked, that banks which trade into different markets with an intention to earn profit, which segment we should classify? So typically most of the banks generally are not involved in proprietary trading, okay, because that is not their business. So they do not trade in forex or in derivatives unless and until they're required to hedge. And most of this category, depending on what is the purpose of hedge, but we'll classify them on the commercial side. Okay, so banks will enter forwards for you. So bank will be your counterparty, but then to hedge its exposure, it will again enter into a derivative somewhere else. So these are mostly hedging activities. Sorry? Source of wholesale funds for the wholesale bank, there could be multiple sources. I mean, it could be deposits, it could be through borrowings, it could be from different sources. So the liability for the wholesale banking, again, it could be from individual investors, it could be from corporates, it could be from different products. Any questions here? Okay. Typically, the spread between the cost of fund and the lending rate is smaller for wholesale banking than retail banking. Okay, so this is what we are going to write down. Typically, the spread between cost of fund and the lending rate, is smaller for wholesale banking. So it might work like this. Now it's not on one-on-one basis, but just to help you build imagination. Imagine an individual comes, he is willing to make a deposit. So on the deposit, you offer him a return of, let's say, 1.5%. Then an individual comes who is willing to borrow, and on the borrowing, you charge him an interest of, let us say, 3.2%. Now, this is what we see in retail banking. In a wholesale banking scenario, let us say you might raise money through certificate of deposits. So you float your CDs in the market, and your cost of borrowing turns out to be, let us say, 1.6%. And then you allow some large corporate house to borrow that money, and the borrowing cost might turn out to be, let us say, 2.9%. So what is happening in this corporate banking scenario is the spread between the two sections is relatively lesser, but even though spread is lesser, the cost of acquiring this business is relatively lesser, which compensates for the smaller spreads. Are we okay with this? Banks that are heavily involved in wholesale banking may fund their lending by borrowing in financial markets. So typically through products like mostly CDs, and are referred to as money center banks. So this term, which is a very US market specific, you should have in your notes. Write down. Banks that are heavily involved in wholesale banking. Banks that are heavily involved in wholesale banking may fund their lending by borrowing in financial markets and then make an arrow and say these are called money center banks. Money center banks. Commercial banking is virtually all countries has been subject to great deal of regulation. This is because most national governments consider it important that individual and companies have confidence in the banking system. Okay, so see, for these readings, I've actually taken stuff directly from the John Hull book rather than using your notes, because I thought since the reading are newly introduced, there is a higher probability of being tested, and readings like these are very easy to read, but the questions could be difficult, especially because it's all theory. So I want you to be focused here. Among the issues addressed by regulation, capital that banks must keep, the activities they are allowed to engage in, deposit insurance, and the extent to which mergers and foreign ownership are allowed. So let's make a list of regulation. So you would write down general banking regulation areas. General banking regulation areas. What are the aspects on which there are stringent regulations? So number one is capital. 20-30% of your FRM part 2 is focused on this point about capital requirement of the banks. So what amount of capital is required for operational risk, what amount for market risk, what amount for credit risk, then whether subordinated debt should be classified as capital, different definitions of capital. Right now you just need to know that there are a lot of regulations on capital. Then point number 2, activities permitted. Activities permitted. Okay, so whether a bank can it run investment banking and commercial banking business from the same setup? Are they allowed to do it? Or whether banks are allowed to enter into proprietary trading, as he asked. So all these are regulated by those regulators. Third, deposit insurance. Do you understand deposit insurance? So anyone working in Indian banks here? You work in a bank, right? No. Do we have any insurance for deposits in India? Up to 100,000 rupees? Up to 100,000? Okay. So in US, they have similar regulations. We'll see the numbers now. So if you make a retail deposit into a bank and for some reason that bank is forced to liquidate, okay, then your deposits are guaranteed by the US Fed. Okay, so even if bank's balance sheet goes completely, it goes into liquidation and losses, then also you have a guarantee from the US Fed. There's a separate fund which is created for that purpose. Okay, so all that is part of regulation. The next point, whether mergers and foreign ownership are allowed. Deposit insurance is you put your money into a bank fixed deposit. So for some reason the bank has gone bankrupt, then the central government will give you a guarantee that your money would be paid back to you. That is a deposit insurance. There is no insurance fee premium per se. There is a premium that you don't have to pay. The bank pays to the somebody. So it again varies, but in US they created a fund for it. Okay, so there is a fund which is a very large size. I think 25 billion is what I read last time. And then every time something goes wrong with the bank, the money is pulled out of the fund. And what banks need to do is banks needs to pay a premium to this fund. Should we go ahead? That is different, yes. The reserve ratios, the amount of reserves that you keep, that is a different amount. Yes, most of the banks in US, JP Morgan, all these are consolidated banks. They acquired multiple commercial banks and investment banks. So you can run commercial banking and investment banking separately, and the history of that is coming. So there were times when it was allowed, then there were times when it was not allowed, then there were times it was allowed again. Right now it is allowed, but you're supposed to fence it. Fence it doesn't run completely independent operations of both the businesses. You cannot run them together. That depends on the question she asked. Are there any restrictions on foreign banks right now? From the Indian perspective, I don't know, but I don't think there are, because we have so many foreign banks operating in India for so many years. So had there been any restrictions, they would have had Indian partners. Like we would have had, Birla, HSBC Bank, together, but we don't have that, which means they can operate by themselves. Should we go ahead? In US, it is unusual in that it has a large number of banks. So 5809 in 2014. And that's because I think even in India we'll have a large number of banks if you include the cooperative banks, right? Every lane you would find one cooperative bank in business. And there are surprisingly cooperative banks even for foreign country citizen, like Indians who've settled abroad. Okay, so I recently got to know that there's a cooperative bank in India which kind of caters to Indians who've settled in Tanzania. So Indians who've settled in Tanzania, those people typically put their money into that particular cooperative bank. And there are cooperative banks for communities, like smaller communities. So banks are creative in finding ways around regulation, particularly when it is profitable for them to do so. An important provisioning of Dodd-Frank is what is known as the Volcker Rule, which prevents proprietary trading by deposit-taking institution. Okay, so this rule, not from exam perspective, but maybe interview perspective, if you ever get interviewed in this section, so you should have it in your notes. Volcker Rule is, it prevents proprietary trading by deposit-taking institutions. Volcker Rule prevents proprietary trading by deposit-taking institutions. So even if they don't ask you question in the interview, since you know the rule, so I don't remember what you were asking, but I remember Volcker Rule right now. Should we go ahead? Did you understand what this means? So if you are taking deposits, then you cannot be doing proprietary trading, as in you cannot trade for your own money, but of course you can always trade on behalf of the clients. Banks can trade in order to satisfy needs of their clients, and the trades which are required to hedge the positions, but they cannot take speculative positions.